Okay, so good morning. So today we'll be looking at IAS 16 on property, plant, and equipment. Remember last week we solved the question on presentation of financial statements. And what that is supposed to prepare you for is for you to fully have a good grasp of how do you present or the structure of a financial statement. And if you look at the statement of financial position, one of the first item under non-current assets is always PPE, like land and building, furniture and fittings, motor vehicle. And beyond that, we have intangible assets. And in some instances, we have also seen financial assets. And in other instances, we have seen investment property. You see, the journey we are starting today is we are going to be picking those items one by one, and we'll try and dig deep to understand how do you recognize and measure them. That is the journey we want to start today. And the very first of them we are picking under non-current asset today is property, plant, and equipment. And this is governed by IAS 16. And the first thing we need to establish first is what is property, plant, and equipment. And for us to understand that, we have to look at how the standard has defined it. Okay, so let's see how IAS 16 defined property, plant, and equipment. So let me start with the definition. It said that PPE is any tangible item that are held for use in the production or supply of goods or services, rentals to others, and for administrative purposes, and they are held for more than 1 year. Okay, so this is the definition given by IAS 16 for PPE. So let's look at it closely to understand it. Even though the examiner will not ask you for this definition, but it's important to appreciate what actually means. So for us to categorize an item as PPE, this standard is saying that that item must be what? That's the first important thing there. That means for any item to be PPE, it has to be tangible, meaning that you must be able to see or touch it, or categorically it must have a physical substance, right? So it must be tangible. That's one. Two is that the item must be held for what? For use. Because if you are holding it, you can hold it for a variety of purposes. And the one that is clear is that you might either hold it to want to sell it, or you might hold it to want to use it within your company. What is important here is that you must hold it to what? Use within your entity. And what are the use cases here? The first use case is that you must hold it for either production or what? Or supply. Production or supply, let's start with production. This will be pronounced in a manufacturing setting, an entity that usually produces goods or services. That means the item that is used for that production, that will definitely be their machinery or their plant that they are using to produce whatever it is they are producing. It's PPE. Even if you are selling Zobo, that item that you are using to produce your Zobo is PPE. Just think of anything you are producing And that item or equipment that is facilitating that production is definitely what? PPA. The second use case is that it could be used for supply. And supply, what comes to mind will be delivery van or whatever vehicle that you use to supply. And if you go to the oil and gas industry, those then we'll be talking about maybe like a pipeline. So it depends on what you are supplying, right? If you are supplying physical goods, then we'll be talking about delivery van and the rest. If you are supplying oil and gas, we're talking about pipes and whatever it is you are supplying. That item that is facilitating that supply would definitely be what? PPE. Now, goods or services. The next one is rentals to others. So if you are holding an item that you are renting it out, meaning that they will return it at the expiry date, right? Then that item is definitely PPE. The basic example is that if, I think some people rent wig, Abby. So if you have wig that you rent out, for you that you are renting it, that wig to you is PPE, right? So if you can understand that basically, that is PPE. So you can think of any other item that you rent out, okay? You give it out, the guy will pay you, then later he returns it. For you that is renting it out, is PPE to you, okay? So rentals to others, and the final one is what? Administrative purposes. And for administrative purposes will be items like, let's say, furniture and fittings, right? Air conditioners, elevator, your laptop, all of those other items that we don't usually use them directly in production or supply, but at least they are useful for us to do our work. Okay, those ones are held for what? Administrative purposes. Okay, so from here now, we can see that for an item to be PPE, it must be tangible. That's one. Two, we have to be using it for either production or supply, rentals to others, and for what? Administrative purposes. Those are the three use cases as seen by the standard. Now, and very importantly, even if you have an item that is tangible and you use it for all of this, and your intention is that you are going to dispose of it or you stop using it at the end of the year or within 1 year, then it is not PPE. Because for it to be PPE, it must be held for more than what? 1 year. Okay? So because of this second point, then we can easily conclude that PPE must be classified as a non-current asset. Because a non-current asset must be held for more than 1 year. Okay? So this completes the definition of what PPE is, right? Yeah, as much as you need to know this definition by heart, it is even more important if you understand it, right? You should be able to easily summarize and know that PPE is tangible item. You must be using it within your entity for production or supply, rent out to others, and for administrative purposes, and it must be held for more than 1 year. And from there, there are numerous examples, right? Numerous examples. So any item that has any of these use cases would probably be PPE. Now, that's the definition. If you now have an item like this, then as an accountant, our work is to record it in the books, or what we say we'll be calling recognition. We will recognize it in the books. So IAS 16 says that before you can recognize an item of PPE in your books, it must meet two criteria. And what are those two criteria? So that takes us to the recognition criteria for PPE. Recognition criteria for PPE. Number one, what do you say? It is what? That future economic benefits associated with the item will flow to whom? will flow to the entity. And number two, it must what? Have a cost that can be what? That can be measured. Okay, so this they can ask in the exam. They can ask you. So we need to know this very well. Now, the recognition criteria, majorly here is that we are saying it is probable that future economic benefits associated with the item will flow to the entity, right? So what we are saying is this: before you can recognize that item as PP, it must generate future economic benefit. Not just generating future economic benefit, but it must what? Flow to the entity. You see, this benefit flowing to the entity, what it demonstrates is that you have control. That's what's important. If you remember the definition of asset in the conceptual framework, economic resource that is controlled. What signifies control is the flow of economic benefit to you. If it doesn't flow to you, then you don't have control. So this signifies control. So probable that future economic benefit will flow to the entity. And second is that it must have a cost that can be measured reliably. Okay, measurements or determination of cost is also very important here. Meaning that if you don't have or cannot determine the cost, then you cannot recognize it in your books. Okay, so these are the two recognition criteria. Now, we now want to recognize it. Let's say it has met this criteria, this recognition criteria. Then how do we then record it in our books? That means we are probably going to be passing how many entries? 2 entries, double entry, right? So let's say the item in question is motor vehicle. Let's say it's motor vehicle. So how do we put it in our books? What items will it impact? Mr. Omar, what items will it impact in our books? Okay, it will affect the motor vehicle. Okay, that's correct. What other item? That's correct. Yeah. So he said that if you are paying outrightly, you are definitely going to be crediting your bank because asset is reducing. For the fact that you are paying out money, credit your bank. And of course, you are now bringing in another asset. So another type of asset is increasing. That means you are going to debit that motor vehicle. Fantastic, Mr. Omar. Now, the next thing is this. You have now recorded it. What is ultimately important in reporting is for us to determine the amount at which we are going to record it. So the amount at which we record item or we recognize items in the books, what do we call it? We call it measurement. And see, this measurement, at the date you bought it or at the date of acquisition, the amount at which you put it in your books, that type of measurement, we call it initial measurement. So measurements in the books usually start with an initial measurement. Initial, which is the measurement at the date of acquisition. And at how much do you think we will recognize it or measure it in our books at the date of acquisition? At the what? At the cost. Okay? At the cost. So that's very correct. So the initial measurement is always the what? Is always the cost. Now, but the thing is this. When we say costs, then what is this cost? What is inherent in a cost? So, the one that's clear, you can give me one element of cost. When we say cost, so what does that mean? The amount you have purchased it. Abi? So, that will be the what? The purchase price. If you are importing these items from a foreign country, then you are going to include the what? import duty. You will see that usually, whether you are importing it, whether you are buying it locally, whenever you buy, you definitely, there will be VAT on it. So let's say you bought it for 10,000 naira, okay, and there is VAT. Let's say, let's use Nigerian rate, 750. Total is 10,750. My question to you is this. Do you think we should include this as part of our cost, making our total cost of this asset to be 10,750, or it should still be 10,000? It should be how much? Okay, you might be right and you might be wrong. It depends. It depends on your intent for this item. Not all of them that is capitalized. You have to look at it. If you are able to claim back this impute VAT, because this is an impute VAT, if you're able to claim it back from FIRS, if FIRS is going to give you or pay you back or as a deduction from your output, okay, so that means it is a refundable VAT. If it is refundable, you cannot capitalize the cost. You can only capitalize it if it is non-refundable, meaning you cannot claim it. FRS don't allow you to claim it. And of course, if you look at the nature of PPE, you cannot claim it. At least to a large extent, you cannot claim it because the only one you can claim is probably if you have to sell that item. That's when you also have an opportunity to charge output VAT. Then you can then net off the two. But in this instance, it's non-refundable. So we have to be specific, or we have to be sure that this VAT is non-refundable. If it's the one that the government will pay you back, or the one you can claim back, that one should not be capitalized. So the one that is capitalized or added as part of our cost is what? Non-refundable. I will call it purchase taxes, because that was the name IAS 16 called it. The reason I'm not calling it VAT for IAS 16 is because IAS 16 is an international standard. Even though we call that VAT in Nigeria, in some other countries they don't call it VAT. Okay, that's why they simply called it purchase taxes. Okay, so but you know that it's the same thing as what? VAT. So if you call it VAT for an ICANN exam, the guy will mark you correct. You're correct. Okay, but let me be compliant with the standard. So non-refundable purchase what? Taxes. All these are going to be added. Now, if the supplier is generous and he gave you a discount, he gave you a discount of 10% off your goods. My question to you is this. Will our cost of this asset be 10,750 or it will now be 10,642? 10,000 what? 750. 10,006. 10,750. Okay. So good. We're having two school of thought. So we want to represent the 10,750 school of thought and explain your logic. I heard your voice clearly. So you are the school of thought of whom? 10,750. So tell me why. Why do you think it should be 10,750?
Okay, why I think it's 10,000 is that the VAT is 7.5%. Like it's a statutory requirement. Like it's a must that you pay. So the fact that you're enjoying 10% discount doesn't mean it's going to be so all the time. So I give you 10%. It doesn't mean I'll give the next person. So the standard is 7.5%. That's the VAT. So that's my own.
Okay, that's not bad. Because this one is occasional. It's not something that's permanent. That's why you think we should not have removed it from our cost. Okay, who was the school of thought for 10642? Unusa. Okay.
Yeah, the reason I think it's 10,642 is because it's a discount.
Okay.
And whenever you receive a discount from purchases, you less it from the cost of purchasing the item.
Okay, that's good. So now, UNISA is of the school of thought that it doesn't matter whether it's permanent or temporary. The fact that in this transaction you have been given, then it should be what? It should be deducted. Okay, so now, see, the right position is that both of them might be correct and both of you might be wrong. So you need to dig deep into the discount itself. You need to understand what type of discount are we talking about. You need to understand what type of discount we are talking about. And the examiner will tell you clearly the type of discount. So they won't tell you like this discount. No, they will tell you the type of discount. And there are two types of discount we can have. Okay. Practically, there is one to encourage you to pay early. They call it early settlement discount. And that type of discount, we call it a cash discount. So the examiner might either call it early settlement discount or he calls it what? Cash discount. You see, for early settlement discount, the guy is saying pay early. If you pay early, I will reduce your money by how much? By 10%. You see, for early settlement discount, that one is something that we are not sure whether we will get it or not. If you pay early, you will get it. If you don't pay early, you will not get it. So for that reason first, you cannot use it to reduce your what? Your cost. Because when we are talking about initial measurement, we are talking about what is the cost at the date of what? Acquisition. So you cannot include or remove something you are not sure that you will get. Okay? And as far as early settlement discount is concerned, it is never removed from our costs. When we eventually get it, the standard says that you simply treat it as an income. That is what we call discount received. So you don't credit assets. No, with that early settlement discount. What you credit is what? Income. So when you see discount received, is early settlement discount they are talking about. Now, another type of discount is the discount that they give to, let's say you are a first-time buyer, that they just want to encourage you to keep coming. Or the one that they want you to buy plenty, bulk discount, that buy plenty. Or the one is that they will say buy one get one free, all type of discount so that you can buy plenty. That is a trade discount. It's a trade discount. And that type of discount is like you get it automatically almost immediately. It's reduced from your cost right from that date. They know that they want to give it to you. So trade discount. So for trade discount, that is immediately removed from your invoice right from day one. So that what you are paying to the supplier, your understanding is that you're going to pay the what? The net. So the one you remove is what? Trade discount. Right? So now, then the final thing here is that we will less what? Sometimes they call it rebates. Rebates. Okay, so this is the first component of cost, at least that is related to the purchase price. The first one is the purchase price. Then you add your import duty. Then non-refundable purchase taxes. Then you deduct what? Trade discount or rebates. That's the first component. So the second one is directly attributable what? Directly attributable costs. You see, these directly attributable costs, they are the costs of bringing the assets to its location and condition ready for what? For use. These are directly attributable costs. These are the costs of bringing the asset to its location and condition ready for use. You see, from that, you will see that these directly attributable costs, if you don't incur them, the assets will not be ready for use. You have to incur them for it to be ready. And the first one is what we call initial delivery and what? And handling what? And handling costs. Initial delivery and handling costs. You know what delivery is now? Transportation costs. You know what handling is now? Packaging. If there's packaging, if you have to pay for packaging, or maybe when you were bringing it, Agbero stopped you and they said they want to collect money, or maybe you have to offload it when you get to where you want to deliver it. All of those ones are handling costs. Okay, so when you eventually deliver it, of course, you might have to probably do some preparation. Maybe you have to do a pavement on the floor. If it's a generator, you have to build a structure. Whatever it is you have to do, then we'll be talking about installation. If you have to couple it together, installation and an assembly cost. Similar to that is site preparation cost. Site preparation costs. This is also part of the directly attributable costs. Another one is, we call this professional fees. And professional fees will be popular in a case whereby you want to erect a building yourself. You want to construct a building and you have to get some architects to do some drawings. You have to get some engineers to do maybe structural plan, whatever. Then that is where professional fees will become relevant. Okay? Another one is, they call this testing costs. Testing costs. So, as the name implies, if you have to test whether that product or that machinery or that PP is working properly, you have to test it. Okay? Though it is not asset that you test. And a practical example I can give you is that if it's an assembly line, for example, now, those that manufacture car, okay, if they just bought the assembly line, what they use to manufacture their car, right? They need to test it and see that can this thing actually do all of the things we want it to do until whatever. So they will test it. And this testing cost will require them, maybe they have to buy some materials, they have to pay some people, any cost they have to incur just to test. Then, you see, it's part of getting the assets ready because they can eventually test it and the thing will not work. They will simply return it, or maybe they have to do some upgrade. But testing cost is part of what will make it in a condition ready for use. And finally, is that this testing costs. You see, what happens if after you have tested, you have bought materials, bought everything, and you're able to now, the thing worked successfully, and you produce the product. You see, that one we call it samples, Abi. So if you now sell those samples, the standard says don't treat that one as revenue. Since that cost of producing that one, we capitalized it, we didn't expense it, we capitalized it and call it testing cost. Then what you got from it, if you sell it, you have to come and reduce it from here. So you have to less sales proceeds from where? You have to come and reduce it from here. Sales proceeds from samples. Another one, which is the final one, is employee benefits. Employee benefits that are directly attributable to the construction of the assets. To the construction of the assets. When I say employee benefits here, what I simply mean is staff costs. Okay? So if we are talking about some of your staff, if they are involved in the construction of the item, or even the installation of the item, if they are involved in that, that portion of their salary you pay to them for that month, if they're able to do that for 1 or 2 days, the standard says that that portion that they dedicated to that machinery, you should capitalize that portion of their salary. It's only the remaining that you expense as your normal salaries and wages. So the standard is saying employee benefits that are directly attributable to the construction of the asset. Okay, see, these six I've given you is what the standard specifically mentioned as directly attributable cost. And you're expected to know the six. You should know it because I can have asked it severally for 5 marks. That's a lot. So you need to know initial delivery and handling costs, installation and assembly costs, site preparation costs, professional fees, testing costs less sales proceeds from samples, employee benefits that are directly attributable to the construction of the asset. So any costs that we incur relating to this must be added as part of the cost of the assets. Okay, so these are majorly the costs of an asset. But there's a final one mentioned in the standard. This one relates to a situation whereby when you have concluded the term of the asset, or when we have finished using the asset, and you are required to, okay, there's an enabling law that requires that you must dismantle the assets and remove the assets and restore the site back to the way you met it. Okay? If that's the situation, then the cost you will incur in the future, it's not something you incur now. It's a cost you incur when? In the future. The standard says you need to estimate that cost. This one, you have to estimate it. You can't know for sure. Any cost you incur in the future, you have to only what? Estimate. Okay, this is one of the areas in reporting where we make estimation. So probably we'll call a professional and say, please, we want to do this after 10 years, after 5 years. How much do you think we'll spend? So the guy will give us an estimate. You see, the estimate the guy gives to us will be capitalized. We call that initial estimate of dismantling, removal, and restoring the site to its original condition. This must be capitalized as part of the cost of the asset. Okay. I have to hear you. This your question is important.
You find out that in some organizations that purchase PPE from abroad, normally even before the PPE is being delivered, some staff will be sent on training. So what will happen to that cost? Will you capitalize the cost, or how are you going to treat it?
Okay, so question is training costs. Are we going to capitalize it or expense it? Are we capitalizing it or expensing it? The training costs, we expense it, capitalize it. expense it. Okay, let's do like this. Those in favor of capitalizing, let me see your hands. Those in favor of capitalizing, let's see your hands. Very few of you. Very few. Okay, that means remaining and supporting expensive. Abi? You cannot be you cannot be in the middle. You have to put it in your books. You have incurred it as an accountant, so you have to make a choice. Are you adding it as part of the cost of the asset, or are you taking it to P&L? Okay, so the guys that said we should capitalize, who wants to represent you? Why do you say we? Do you want to represent them? Okay, so why do you think we should capitalize training costs?
I think we should capitalize because it's part of the cost used to get that particular equipment ready for use.
Okay, what's your name again? Sorry. Timileyin. So you said that. Timileyin said we need to capitalize it because it helps to get the assets ready for use. He's saying that if you don't train them, the assets will not be ready for use. Abi? So the school of thought saying we should expense. Who is representing you guys? You want to?
I just believe that okay, maybe we bought a plant and we fixed the plant. The cost has finished. The cost of training is just after we have fixed the plant. So I just want to say that that one is an expense.
Okay. So she said that it's not really required to get the assets ready for use. It's not really required to get the asset for use. Okay, I think I want to agree with that. I want to agree with her because I don't know why you have to employ people that won't know how to use the assets. Why don't you just employ people that know how to use it? Are you saying that there is nobody? Okay, so when we have that kind of situation in reporting, and there's a choice for you to go for people that know how to use it, maybe it's some people that developed it. Maybe it's somebody in this life that developed it. So even though it's innovation, so when we have that kind of situation in reporting, I mean, apart from that, let's look at the assets. Is the asset ready? Yes, it's ready. It's not. Don't mix training with manufacturing. No, they are not the one that manufactured it. Too. We only want to train them to use it. Too. The question is the asset ready? Is the asset ready? So it's just a question. We don't know how to use it now. We'll fire you. Go and employ people that will use it.
But the cost of training them at
Eh,
that point,
eh,
I'm not sure it's
eh,
directly attributable to the usage that moment.
eh.
It's just in preparation
Okay.
for the usage of that asset.
So what you are saying in essence is that
We capitalize.
if we don't train them,
We cannot use
mm-mm,
it.
mm-mm, mm-mm. Don't mix usage with readiness. The standard said that is the asset ready for use. So as far as accounting is concerned, you see, as far as accounting is concerned, we don't care whether you use it or not. It's none of our business. Our business is the asset ready for you. So it is not your choice whether you use it or not. But is it ready? That is our mindset. So the usage is not what we are looking at. You will see as we move on, you see that usage is not, we are not accounting for usage. As far as PP is concerned, we are accounting for readiness. You will get there. You will see that even if you don't use an asset for the next 5 years, you will be depreciating it, even if you are not using it. So if you like go and train them for 10 years, every year you'll be expensing that training costs. You will never capitalize training costs.
So when does the depreciation start on assets?
What do you say?
When does the depreciation start on an asset?
As soon as it's ready for use. As soon as it's ready for use. So any course, when after it's ready, you go and train it back. So if you are saying training, then if you want to now open it, you want to do an opening ceremony for the asset. So let's capitalize that one too. It's the same, it's not different. You want to ask a question? Okay. She's still not agreeing. She's still not agreeing.
Now, so if I have an office now,
Yeah.
and probably there's the opening or launching,
Mm.
do I capitalize?
No, now. You expense it. You expense it. So what is important for us is the asset ready? That's the main point there. Wow, that's fantastic. Okay, so okay, yes. So he's talking about, let's say, after you have bought it. Okay, let me take it to PP. After you have bought it, you now agree with the supplier that okay, there will be, let's do a contract for 5 years that will be maintaining these things for you for the next 5 years. You expense it over 5 years. Yes, you expense it because usually they will have paid. Okay, I will pay you 10 million for your maintenance contract, or sometimes they'll put them on retainership instead of paying one off. So every year you're expensing and you don't capitalize that. Okay, so the professional fees here, like I explained it, I was very specific that this would usually relate to when you want to construct an asset from like ground up. Okay, like maybe you need an architect to do some drawings for you, or maybe you need an engineer to do some drawings for you, or maybe it's a something that require a lawyer drawing up a document before it can be ready for use. See those costs. So this one professional fee is different from the after it's ready. So this is a professional fee that if you don't incur it, you cannot start using the asset. Or sorry, the asset will not be ready. You are not legally or being able to um, have access to that asset being ready. Okay, that was a good question, Mr. Omar. That was a good question. Okay.
Like the third one, you said the cost of. You said the cost of dismantling the item. Now we said the PP is we said once the PP is ready for use, then we are okay. But now the PP is ready for use, and we are also estimating costs for dismantling in future. So I'm trying to, is it capitalized or?
Okay, so that's also a fantastic question. That's a fantastic question. So he said that yes, the asset is ready for use, and yet we're including the cost of dismantling. That's a future cost. Yeah, meaning I mean it's included in the standard. It's specifically included in the standard that you should capitalize that. And the only situation that would happen is a situation where it is required by law. So you know it right from the beginning that at the expiration of these assets, when you finish using that asset, you have to dismantle, remove, and restore. And that is mostly common in oil and gas industry where they are drilling in an area, they will put their heavy machinery there to drill crude oil from the ground. So when they drill, after the expiration of their OML license, they are required to clean the area and restore it back to the way they have actually met it. See, that's where it's common majorly. See, that kind of situation, that future cost, you have to capitalize it. But in reporting, if you remember the measurement basis I taught you under the conceptual framework, there are two measurement bases. There's the historical costs and there is the current value. And current value, there is value in use, net realizable value, and current cost. We don't have future cost. So whenever we have future costs, we need to bring it back to present value. You need to what? Bring it back to present value through discounting. And do you know how to discount to present value? It's simply going to be this. Future value into bracket 1 plus r raised to power minus what? N. So usually, what the examiner will do to you is that they will tell you that in the next 5 years, so they will dismantle these assets at 50 million. The guy will just be looking at you. He'll be waiting for you to add that 50 million and he'll be happily to mark you bad. So you as a smart student, they will have given you the number of years, they will have given you the what? The discount rates. You have to remember to discount it back to what? To present value. Because what you add is the what? Is the present value. And in some instances, the examiner will just simply give you the present value. They will give you the present value directly. Okay, So this is the component of the cost of an asset. Okay? They have asked this area. I can like asking this area a lot. So this is something you need to know perfectly well.
They ask question about this initial measurement. We
Okay?
have to write you this all these points.
Yes.
Okay.
Everything. Okay, so the way they have asked in the past is they will ask you to list and explain the component of costs of an item of PPE. Okay? They will ask you to list and explain the what? The component of costs of an item of PPE. And in some other areas, they will give you some figures and notes, and they will ask you that calculate the cost of this asset. That's how they have asked. The most recent one that they have asked in 2021 or thereabout, they gave you figures and they asked you to calculate the machine cost. It was for 8 marks. Yeah, 8 marks. Ordinarily, my students should get 8 marks because we will have solved similar questions in class. No, it's not possible. You can't. And every day they will put training cost there because they know that in the class, when people will not still agree that training cost should be that training cost should be expressed. They will see, no, that guy, no, I will capitalize it. And I will have told my guys.
Difficult.
Yeah.
Is the part of that employee benefit.
Okay.
No, it is salary.
Yeah.
And what you pick out from there is that money you have spent on them while they were working using any of the assets.
Okay.
You know, it's a bit.
Yeah, I get what you're saying. I see what you're saying now. Yeah.
What I understood from all this, any cost that is not attributed directly to the asset should be expensed.
Exactly.
That's just it.
Exactly. I mean, you can also see it as any cost that gets it ready for you should be capitalized. Anyone you incur after that date should be expensed. Should be. So the key thing is everything stops when it is ready. Any other one you incur after it's ready should be what? Expensed. So let's look at it. There is one that wasn't mentioned in the standard. It wasn't mentioned in IAS 16, but it was mentioned in IAS 23. I will still teach you IAS 23. IAS 23 talks about interest when you borrow money. And it says that when you borrow money to construct an asset, okay, when you borrow money to do what? To construct an asset, the interest you are paying on that borrowing, he said you should be adding it to the cost of the asset until the asset is ready. If you are still paying interest after the asset is ready, that one will be what? Expense. Okay? It wasn't mentioned in the standard, but we will still teach you IS 23. But we have found it in some questions in IS 16 that they will say, okay, borrowing costs for 1 year. They will now tell you that this asset was ready in 9 months. They'll be waiting for you and see whether you prorate it by 9 months or not. Okay? So in some assignment I will give you, even today, you will see it there that borrowing cost must be what? Must be added as part of the cost of the asset. Not the money you borrowed, though, but rather is the interest you are paying that you capitalize, not the money you borrowed, the interest you are paying. And you capitalize up to the point when the asset is what? Ready. After that date, you just expense every other interest you're paying to the bank. Aside from that, this is everything as far as the cost of an asset is concerned. Okay, okay. Now we have been saying, okay, where is ready? When is ready? When is ready? Okay, the cost we incur after it's ready. The standard specifically has a name for that, and it called that subsequent cost. So when it is now ready for use, capitalization stops, at least as far as those one relating to the date of acquisition is concerned. Any other one you incur after the asset is ready, we call it what? Subsequent costs. So what we are saying in essence is that subsequent costs should be what? Expensed. And a typical subsequent cost are things like repairs and what? maintenance. It goes to where? It goes to the statement of profit or loss. Another typical subsequent cost we usually have is replacement of what? Replacement of parts. Okay, so if you have to, after initial acquisition, you have to now replace some parts. You see, this type of subsequent cost, you need to what? You need to capitalize it. So even after initial acquisition. But this is a major one. Replacement of what? Parts. So when I say capitalize, what I mean is that you add it to the cost of the asset. Replacement of parts. But usually what we have seen is that the examiner will just tell you that, okay, we incur this cost to replace parts, 50 million or 50,000. You simply add it back to the cost. But the complete treatment is that since you are replacing a part, definitely that means you are removing something out. Abi? You are removing something out. If by accident the examiner gives you the cost of the portion you are removing, you need to remember to remove it. You need to remember to what? Remove it from the cost of that because it's going off. It's like you are removing that portion and you are adding a new one. So you have to remember that. But I've not seen from I kind of started asking questions. They have not given you that.
Sorry, the part you are removing.
Yes.
Like, the cost are not the disposal value of that part. What if the part is no longer useful? Or are you looking at the scrap value?
Whatever it is, it has to be the costs at which you recognize that part initially. Okay. So if there's a part that you have to, let's say a car now, you now want to replace the engine. Okay, you now remove the engine. If you know the cost of that part you are removing, minus it from the cost, remove it, right? Then the one you are now bringing back, you add it to the cost. Yeah, that's what we are saying. Okay, but I've not seen that situation. They can. I'm just telling you the real how it's completely treated. But what you find in your exam is that the examiner will tell you, okay, they replaced the part for 50,000, and the guy will just stop. What you just simply do is just what? Add it, and that's it. Okay, when you replace a part, a major part, it should be what? Added to the cost of the asset. Another subsequent cost is they call this major inspection. Major inspection. You see, this usually happens for certain categories of assets where every three years they will come for major. It's different from repairs and maintenance. They will come for major inspection, and usually it's major inspection that will usually leads to replacement of parts. Okay, so if you have major inspection, the standard also says that you should what? You should capitalize it. But I think the core question is this: we are saying repairs and maintenance expense, replacement of part, that one capitalize, major inspection, that one capitalize. I mean, why? Why are we expensing repairs and maintenance and we are capitalizing these other two? What makes us, what is informing this capitalization? What is informing this capitalization? I've seen them ask it before that why would you capitalize a subsequent cost? Why would you capitalize? What do you think is special about these other two that made us to capitalize it?
Say something.
Now, my friend, yeah, tell us. Why do you think we will have capitalized these other two guys?
Okay, I think we are capitalizing them because it's like just like in the form of a building, you are rehabilitating it. So it's just like you are bringing it up again to upgrade it to a new standard.
That makes sense. That's not bad at all. That's not bad at all. He's saying that it's we have upgraded the assets. Majorly, that was what we said. Okay.
Okay, sir, though you systematically asked for the repairs and maintenance, I think that will aid me to answer why we capitalize this. For repairs and maintenance, I feel that part or even the asset is still in use. We're not changing anything. We're just probably repairing. So we're still using that same asset. So we expend that. But for replacement or say subsequent costs, the reason why we capitalize most of these things is because we're buying probably another part to replace. And technically, that part can also be seen as part of the asset.
Okay, so you majorly focused on the fact that we are bringing in new components into the asset. So for that reason alone, it should be capitalized. Okay, so inspection, you see, inspection would majorly result in replacements, right? It's when they come to do their major inspection, then they kind of go hand in hand. Okay, you wanted to say something? Let me give it to him.
Okay. Another reason to purchase what they said also is that normally like the repairs, the machine is still in use, you just maintain it. Now for the replacement of parts, it's like if you don't replace the part, you will dispose the machine, and disposing the machine you will buy new one. So replacing the part means that you are like already buying a new one, so we should capitalize it.
That makes sense. You want to say something? Okay. Those are very fantastic points. I mean, if you can explain this like this in the exam, you easily walk away with your point. You even if you don't remember the points I'm going to give you now, if you can't remember them and you can confidently explain it the way you understand. That's how students pass ICANN exam. It's not by sitting and cramming everything at all. You don't pass ICANN exam that way. You have to express yourself.
I'm thinking since one of our recognition criteria is that it's probable that future economic benefits will flow into the entity, I believe that when we replace the part, it brings life again, which will bring production more than it was before.
You're not technical, no. You're just on point nowadays. That's very good. Okay, I mean, she had just mentioned a very good point. She related it to the recognition criteria. Like what you guys have explained expressively, she related it to recognition criteria that you see this replacement of part and major, they would increase the future economic benefits, right? They would increase it. Okay, I think, and that is major. That's major because why repairs and maintenance can only maintain if the asset can do, let's say, 50,000 units. This one, if you are maintaining it very well, that means it will do these 50,000 units. But with this one, it can do 70,000 units or even more, right? I mean, that's a major one. That's a major one she has mentioned. So even the standard, what the standard said is this, that before you can capitalize a subsequent cost, it must meet the recognition criteria. While you are also clapping for these guys by the side, can you please clap for her? That's a very good one. Yeah. So that's what the standard said. That before you can capitalize a subsequent cost, this is the recognition criteria. Is this same thing? If they ask you, just give this one to them. This same one. Okay? But in addition to this, so that we will understand it, because there are a lot of arguments that we saying that yes, some people will argue to the last and tell you that no, if you repair and maintain very well, you can increase it. Some people will argue it out. Okay, so the way the standard said that, okay, yes, meeting this recognition criteria for subsequent cost, he said it means two things, right? some reasons for capitalization. So we have said that one is it must meet the recognition criteria, which is these two. And I want to explain further that it also means that it must improve or increase the productive capacity of the asset. And two is that it must increase or elongate the useful life of the assets. So majorly, these 2 points also explains why we would capitalize a subsequent cost. Why you would capitalize a subsequent cost. Okay, so in 2022 May died. For 8 marks, the examiner asked you guys that you should list, I think, 4 examples of items or costs that are not directly attributable. It caught a lot of students unaware because the one they know is the one that are what? Yes, most of them have crammed that and they were waiting for. But the examiner went that which one are not directly attributable. We have already mentioned one that we argued in this class already. It's training cost. Abi? Staff training is not directly attributable. So, I mean, it's what's us taking it as a topic now. In case they want to ask it again, so costs that are not directly attributable. You said what? It's training cost. Number two, the cost of opening a new facility. Like I've mentioned before, you have constructed the asset or you have built like a branch. You now open the new facility. That should be expensed. So any cost you would incur for that ceremony must be expensed. The third one, okay, we'll get there. The third one is the cost of introducing a new product. And this is majorly advertisement and what? Advertisement and promotion. Okay, if you have to advertise or promote for whatever reason that you have this asset that you want to rent out, or you have this asset that you can use for this production, then that cost must be expensed. The third one, the third one, or the fourth one, is the cost of starting a business in a new location. So this is like a relocation cost. So if for whatever reason you have to relocate some staff, okay, so that they can use the assets. That cost should be what? Should be expensed because it has nothing to do with the readiness of the asset. So relocation costs must be expensed. Then the fifth one, general and administrative overhead. Things like maybe you have to pay rent and all of these administrative overheads must be expensed. They are not directly attributable to the asset. Another one is pre-operational losses. You have started using the assets and the asset is not operating to capacity, or maybe there are some wastages for whatever reason. You cannot be adding that as part of your cost. No, they should be what? You see, this is I'm actually mentioning it for you. I'm not creating it. It's actually from the standard. You see, this is how the standard has mentioned it. Though the standard did not mention this as a separate line item, he added it as part of this. He said this one including training costs. And so the standard specifically mentioned training costs must be what? Expensed and should not be capitalized as part of the cost of the asset. So in case they ask it again, you must be able to give them, they ask 4 and you have 6. You should be able to. For me, everything we have mentioned today, everything is important. You must know everything by heart as far as IAS 16 is concerned. No. Okay, yes. If you put maintenance costs, it's going to fly. To fly. What about what?
What about the cost of employing new hands?
Cost of employing new hands? You mean you automatically know that that should be expense.
Yeah, so I'm going to ask on okay, so I'm going to ask a question on the replacement of parts. So in a case where the company just buys a part just to keep in case there is a problem, it's not like they are replacing it immediately. Is this supposed to be as recognized as an inventory or still PPE?
That's a good question. That's a very good question. So the question is, if you didn't hear, is that if the company bought a part, it's not that they need it now. They are not replacing it now. They just kept it that in case we need it, in case we need it, then we would. So one is that, of course, it's not going to be inventory. Let's take that out, and we are not going to expense it. You are definitely going to capitalize it. But the point is that you are most likely is you have a choice. Is either you treat it as a separate asset, okay? You can call it whatever name, or you can add it as part of that asset. But the best practice is that since it's not a component of that asset yet, okay, it's advisable to treat it separately. Okay? So the reason is because of you start depreciating it. Yes, you start depreciating it. Reason why we wouldn't advise anybody to add it as part of that asset is because the depreciation rate for that will not be as much as this one, right? Because this one is just there, we're not using it. So we will be depreciating it, but we will depreciate it over a longer time, right? Depreciate over a longer time, right? So we'll capitalize it, it won't be an inventory. Okay, they are doing it the very wrong way. So as an accountant, don't put that as an inventory, right? So and the reason is this: IS2 is clear what an inventory is. It's very very clear. So IS2 says that an inventory is either raw materials, work in progress, or finished good that is held for sale. So if you are not holding it for sale, then it should be so the only one that even for spare parts or some other parts also, if you are keeping them and you are not holding it that you want to resell it, you should not put it as, if that's the practice some people are doing, maybe some people are doing it, but it's not a right practice. Okay, I mean we are looked at the major theoretical side of this standard, and we have looked at everything that has to do with initial measurement, at least that we know that you definitely are going to see in your exam. Now let's move forward to subsequent measurements, because what we have looked at is initial measurement, which is the measurement at the date of acquisition, and subsequent measurement is quite different. And what is subsequent measurement? So if initial measurement is measurement at the date of acquisition, what should be subsequent measurement? Let me give it to that guy. He wants to say something. When you finish talking, give it to me, sir. What's subsequent measurement?
Subsequent measurement up to the next year.
Testing the microphone. So I think subsequent measurement is the cost of an asset at the end of every year. Yes, sir.
Subsequent measurement, I feel like is measurement after the initial measurement, like yearly, annually measurement, maybe measurement after the initial one. That's what I feel. Measurement after
You're all correct, but UNISA is more correct. Subsequent measurement is measurement at the end of each year. Okay, so it was very accurate. It's measurement at the end of what? Each year. So, what subsequent measurement? The last time they asked this as a direct question, they asked us to list and explain the subsequent measurement basis for PPE for 6 marks that diet. So, we have the cost model, and we have the evaluation what? Model. We have the cost model and what? Revaluation model. This one is different from initial cost too. You see that this one is a model, right? Meaning it will involve some calculations and what have you. So let's pick it one by one. And the fact that there are two means that an entity must choose one. An entity must what? He has to choose one. And anyone they choose, one of the features of financial statement is consistency of presentation. Is what? Consistency of presentation. They must continue to use that model. It's not encouraged, or we don't advise entities to change. We don't expect that they're going to change. You must continue to use it. Okay, so the challenge you see people finding is that if you are using the cost model and you are depreciating your assets, let's say over 5 years. After 5 years, the value of the asset becomes what? Zero. So to say, is zero in your books. So we have gone for audit and we have seen that the asset in their books was zero, and they are still using the assets and they still left it at zero. So if you are the auditor, what would you have done? Is there no auditor in this class? There's nobody that works around it firm. She said she will evaluate. So you are changing the model. It's not encouraged. You increase the what? Thank you very much. You just mentioned it. Revise the useful life of the asset. That's correct. We'll get there. Okay. So now let's say they have chosen cost model. So how do you get the measurement at the end of the year using the cost model? It's simply the cost minus what? Accumulated depreciation minus what? Accumulated what? What does this give us? Thank you very much. I think you should keep this. Of course, most of you might have heard of this before, but the subsequent measurement or the measurement at the end of the year is called what? Is the carrying amount of the asset. And what about evaluation model? Evaluation model. Evaluation model is simply fair value, or they call it what? Revalued amount minus what? This guy should not be in this class. So, what are you doing here? So, this is the evaluation model. So, this is where the difference comes in. For evaluation model, you don't use the cost, but rather we use what? Fair value or revalued amount. Fair value is like the market value or the selling price of that asset. Then you see another difference is for the accumulated depreciation is always what? Subsequent. You understand this soon. You understand this very soon. It has to be subsequent. So that diet, when they asked this, the examiner was waiting for you in revaluation model. He's consciously waiting and see whether when you are saying deduct this one, you will put subsequent there or not. If you don't put subsequent, that's automatically zero. Yeah, so this thing is very important. This subsequent, extremely. So minus subsequent accumulated depreciation minus accumulated impairment losses. So the subsequent is not really pronounced here. So this for revaluation model. So next week our attention will be on revaluation model. We'll talk about revaluation, how we treat it. But for today, I'll majorly pay attention on the cost model. And the major highlights in this cost model, I think we have already talked about costs. You already know what the component of cost is, which is the initial cost and the component. What we have not talked about is accumulated depreciation that we deduct from the costs every year. And this one, accumulated impairment losses. I think this one is around I think week 9 or 10 topic. IAS 36. So I'm not going to talk about this in IAS 16. IAS 16 did not talk about impairment losses. But you just need to know that whatever impairment loss you calculate, ultimately we're going to deduct it from the cost to determine the carrying amount. So let's start discussing depreciation. Depreciation. I am sure that there is nobody in this class that have not heard of depreciation before. Because for you to be in this class is either you are coming from foundation or you're an accounting graduate. One of the two must suffice. What is depreciation? What is depreciation? Sorry?
Depreciation is the fall in value of an asset over its useful.
Okay, so depreciation is the fall in the value of an asset. Is it correct? Due to its continuous use. Islamia, do you agree? You agree with them? Victor, Abi? What's your name? Marcus, do you agree? You agree with them. What is your name? You never talk in this class. Yes, you. Do you agree? Do you agree with them? Yes or no? Okay, she agrees. Mr. Omog, do you agree? He said that is the fall or reduction in the value of an asset over time. What did he? The guy added something. He added over time. Is that what it is? Please, Unisa.
I think depreciation is a systematic allocation of cost of an asset or depreciable amount over an asset estimated useful life.
I don't know what this guy is doing in this classroom. He already know everything I want to teach. Because this guy is perfectly correct. Okay? I think that as an FR student of ICANN, let this be the last time you will see depreciation as fall in the assets of an asset or reduction in the value of an asset because of usage over time. No, no. That is not what depreciation is. Depreciation is not that at all. It's far from it. It's far from it. And what UNISA has told us is the definition of depreciation in IAS 16. Let's look at that definition and let's explain it very quickly. And IAS 16 said that depreciation is the systematic allocation of the costs or depreciable amount of an asset over its estimated useful life. And year 16 said that depreciation is the systematic allocation of the costs or depreciable amount of an asset over its estimated useful life. Looking at this sentence alone, you will find out that what depreciation is all about is this systematic allocation is like spreading or splitting. Spreading or splitting. What are you splitting or spreading? The cost or what? Or the depreciable amount of an asset over its what? Those are the three things there. And these are the three things we'll talk about in a jiffy. But what is looking at is this. There's a concept in accounting called matching concepts. And there's another concept called accrual concept. Those concepts are what guides reporting. In the sense that what those two concepts are saying is that accrual is saying that you don't recognize expense when you pay it. No, you recognize it as soon as you have what? Incurred it. Matching is saying that for every revenue you recognize in your P&L, there must be a corresponding expense You must match it together with one another. So when we incur costs as an entity, two things can happen. You can incur a cost, and that cost will only generate revenue for 1 year. Those ones are straightforward, meaning the revenue it generates and the costs. So you put the revenue as income, revenue, you put the cost as operating expense, in some instances, cost of sales. It goes on. But there are some costs that when you incur them, they don't generate revenue for 1 year alone. They generate revenue for many years. An example of those costs is what we are discussing today, PPE. Okay, when you have such costs that generate revenue for many years or that we are going to use for many years, you can't expense it for 1 year alone. That is why we go and suspend it somewhere and call it assets. We suspend it somewhere and call it what? Asset. So as we are using it, you'll be expensing it year by year, year by year. So the process of expensing an asset for today's scenario, PPE, that process of expensing it gradually so that you can match it with the revenue it's generating is called what? Depreciation. So depreciation is not fall in the value of an asset. If it is fall in the value of an asset, then why do we depreciate building that will appreciate? A lot of assets do appreciate, that we still depreciate. It has nothing to do with appreciation or whatever, fall or high in value. No, it's just simply complying with matching concept and accrual concept. That's all it's doing. That, okay, we have incurred this so much cost that is going to generate revenue for so many years. Okay, so we cannot recognize all the costs this year alone. We have to spread it over that many years. So the portion you are recognizing each of these years is called what? Depreciation. That's what depreciation is. It's not really more than that. Okay, so and that's what we want to really look at. So the how you spread it or how you determine the portion that goes to each year, there's a method they call systematic allocation. We'll look at it in a jiffy. What are you spreading? The cost or depreciable amount, we'll look at them first. Then the useful life, we'll look at that too. So let's look at this one that is obvious first. The cost or the what? Or the depreciable amount. I won't have to repeat this because we already talked about this extensively. The cost. So I mean, the one we have not mentioned is what? And depreciable amount is simply the cost minus what? Cost minus residual value. They're kind of the same. The only difference is the fact that if you have residual value, you should remove it from the costs. So that what we have left is what? Is depreciable amount. The first thing is this: what is residual value? Some people call it scrap value. And expressively, we can see it as the value of an asset at the end of its useful life. Meaning we have used economically what we need to use from the asset. So whatever is remaining, exactly, is the residual value. So because this residual value is a part of the cost that we are not going to use. Abi? Because we have used it. That's why we are deducting it from the cost. So there's no need to expense that one over the period because we won't use it. We will ultimately sell it. It's a scrap value. Or even, maybe we might even throw it away. Whatever it is we want to do with it. But we will expense that portion. That's why whenever they give you residual value, what do you do with that? Remove it. Remove it from the cost. So that's the depreciable amount. Now, the second one is useful life of the assets. Useful life of the asset is how long the asset will serve you. Abi? The duration. But you need to know that useful life is not only duration. It might be the productive units of the assets. It might be the what? productive units of the asset, and it could be service hours, depending on the type of asset we are talking about. It could even be mileage, right? There are some assets that from the manufacturer, he will have told you that this asset can only go 100,000 miles. Or they will tell you that the output from this asset can only be 100,000 units. As an accountant, that is the what? The useful life of the asset. So on that basis, you can now be knowing how much you want to allocate to each year. But useful life is either the duration in terms of years, it could be the productive units in terms of output, it could be mileage, it could be service hours. Is how long are you going to use the asset? Is what useful life is. I've seen a funny question before in ICANN for I think 4 or 3 marks thereabouts. They said that what usually determines the useful life of the asset? Like what determines how long an asset will, or how long you can use an asset? What are the factors? When I saw it, I said, they want you guys to think. So I said, I'm going to ask you guys. They asked you 2 diets ago. So what are the factors that can determine the useful life of an asset? What are the factors that can determine? Okay, let me start with this simple one. Is the rate of maintenance or repairs on the assets. So if you repair an asset or maintain it regularly, it can serve you for a longer year or longer years. Okay, I've said mine. Who wants to try? Time. I think I will have given you that. I will have given you a mark. Yes. So the time factor too. So over time, definitely you will determine the useful. Yes, it's not bad. Usage of the assets, usage of the asset. So the level of usage on the asset will determine the useful life of the asset. Yeah, that's good. Which other one? There's another one that has to do with contracts or legal framework around the asset. So if you have a contract with somebody that's okay, I'm giving you this asset for 4 years. That means in your books, the useful life is what? It's 4 years. So you can another factor is you're not noting it. You don't notice it though. You're correct with it. You're not noting it. Another one is the legal framework or contract backing the assets. I think the first one we mentioned was yes, the rate of maintenance or repairs. He mentioned the time factor, okay, the level of usage, legal framework or contracts. Okay, we have mentioned 4. They asked 3. Can anybody give us one more? Yeah, now. I thought you wanted to say something. Any other points? What do you say? Yeah. She said company policy. Yes. Expiry dates. This is your point. You pass ICANN easily. It sounds funny, but they make sense. What do you say? Environmental. Yes, that's also correct. Environmental factors. Yes, it's correct. Very correct. Very correct. You mentioned, what's your point again? Sorry. Company's policy. Yes, the company's accounting policy. He mentioned environmental factors. These are good points. These are good points. Other points? Okay, I think we have enough points there. Which one? I don't know anyone again. I mentioned the one I know. Okay, so that's useful life. Now another thing about useful life that is clear here is that is an estimate. Okay, is a what? Is an estimate, meaning it can change. After 2 or 3 years now, you will find out that I made a mistake. This asset can go longer than I initially thought. So you will see in questions that they will tell you that after 3 years, they revised the estimate. The same thing as residual value too. The same thing as residual value, because residual value also is also an estimate. There's no way you can know the value of an asset at the end of its useful life. You can't know it for certainty. You can only estimate it. Okay, so you find out that after some years, they will revise it and say, no, we think it should be this. All of those has factors. They affect how you determine your depreciation ultimately. Now, that's useful life. Now, the final thing here is the systematic allocation, which is the final thing here. In this definition, systematic allocation. Since you now understand that depreciation is just the portion of the cost of an asset that relates to this year, the portion of the cost that we are expensing this year, that's depreciation. So how do you know the proportion of expense? What portion are you going to give to each year? That's systematic allocation. There are a lot of them. The standard mentioned two, and that's what I'll mention in this class. He mentioned straight line method, and he also mentioned reducing balance method. These are the systematic allocation the standard recommended. So the first one, which is the straight line method. This one, from the name, it means that you have to charge equal amount of depreciation every year. That's why they say it's straight line. Charging what? Equal amount of depreciation every year. And the way they achieve that equal amount, they usually calculate depreciation like this. They will do the cost of the asset minus the residual value, if any, divided by what? The estimated, divided by the estimated useful life. So with this now, it's like you are just spreading that value equally over its useful life. It's just like saying 10,000 divided by 5. This gives you 2,000 per annum. That's what this gives us. So if you have residual value, fine. If you don't have residual value, fine. So just get that amount and that's equal. So in some instances, they will not give you useful life in terms of number of years. They can give you this useful life in terms of productive units. They can give you in terms of service hours. We'll look at scenarios like that so that you'll be able to address them in the exam if you see them. But another one they can give us is they can give us this useful life as what? Depreciation rate. It's still the same thing. So if they give us the rate as 20%, so all you need to do is just 20% on what? On the 10,000. And that's 2,000 every year. Okay? So whatever they give us, you are fine. And that's straight line. So it's quite straightforward. The second one is reducing balance method. Reducing balance method. And from the name, it means that the depreciation you charge each year or as the year progresses will be reducing. So as the year progresses, so if you are charging 2,000 in year 1, expect that in year 2 it will be lower than that. It might be 1.8. In year 3, it might be 1.5. So reducing balance. The depreciation as the year progresses reduces. So and the way to achieve that with depreciation, here, the depreciation is simply the depreciation rate multiplied by the what? For this one, they will never give you the useful life. You cannot use useful life in this instance. No. Useful life is not applicable for reducing balance. It is only applicable for straight line. So for reducing balance, is rates they can give you. Is rates. So in the exam, they would always tell you which method of depreciation you should use. They either tell you to use reducing balance or they tell you to use straight line. In case they don't tell you, if they give you useful life alone, you should know that you are definitely going to use what? Straight line method. Okay, so this is how reducing balance work. But another thing, this one not for your exam, but for general knowledge, is that what will inform your choice between whether you should use straight line or reducing balance. Majorly, what the standard says is that if the asset generates equal amount of benefit every year, then you should use straight line method of depreciation so that you can match the benefit and the cost equally. Okay? If it generates equal amount of benefit every year, use straight line. But if the asset generates higher benefits at the earlier years and lower benefit at the later years, then use what? Reducing balance. But in practice, we find out that most entities just use straight line method. Like that's just straightforward for them. Most of them that we have seen use straight line method. Okay, so that is systematic allocation. Finally, on depreciation is this. Let's say we have our depreciation in year 1 to be 2,000 naira. How do you enter it in your books? What are the um, two items that will affect depreciation? What are the two items it will affect? Any hand? What are the two items it will affect? It will affect what? Okay, if we say SOP, you need to be able to tell me, is it as expense or as income? As expense. Okay, you can call it depreciation expense. Okay, that's correct. What again? SOFP. So where? Non-current asset. Okay, that's correct. But one thing is clear is that you don't impact. Yes, the first one that goes to P&L as an expense is fine. Yeah, it's an expense from what I've explained as depreciation. The other one, which is the other leg, that credit, you don't credit asset account. You know what? Because that asset account, nothing touches it except if there is a revaluation. That asset account is always at cost. It doesn't change. So we leave it. So we create another account. We call that accumulated depreciation. So that is where you will now be putting the depreciation you are charging every year. That after 3 years, when you go and look at accumulated depreciation, you can easily know the amount of depreciation you have charged till date. Okay? Why the one that is going to expense? That one, expense goes for that year. But that one that you are keeping as a credit in accumulated, you simply carry them forward year in, year out, year in, year out, year in, year out. So that's why when you see a depreciation figure in the trial balance and it's on the credit side, you should know that this is the accumulated depreciation from last year. Because depreciation is an end of the year adjustment, majorly. It's something you do at the end of the year. So depreciation for the year, for this current year, is not something you find in the trial balance because you only do it at the end of the year. So if you now see a trial balance in the trial balance, if you now see a depreciation in the trial balance, you should know that is what? Accumulated. Except if it's now on the debit. If you see it on the debit, that cannot be accumulated. Maybe for whatever reason or the other, the examiner decided that, okay, they have done the depreciation adjustment for you and is on the debit. And that means the corresponding credit, it will have been included in the accumulated on the credit side. Okay? And that is how you incorporate depreciation into your books. The first leg will be an expense, of course, while the second leg as a credit will go to accumulated depreciation. And if you look at that model I gave you, that accumulated depreciation, ultimately in our workings that we call fixed asset schedule. In a fixed asset schedule every year, we usually will have the cost that does not change year in, year out. We'll net it against the accumulated depreciation. If there's any accumulated impairment, we net that. Then we'll get our what? Carrying amount. Is that carrying amount that we usually take to the statement of financial position. Year in, year out. That's what we do. Year 1, we do that. Year 2, we do that until the end of the useful life of the asset. Now, let's open our pack and let's solve one or two questions. Then we close the class. Is this new or old pack? There were a lot of questions in the pack. Let's start from question 1. Yes, you can go. You can go too. So, who wants to read? Yes, your pack. Which page is it? Page 52, question 1. Page 52, question 1. Hold on, hold on. Hold on, are you all there?
Should I go on? An entity purchased an asset on 1st January 2006 for 10 million naira. The asset has a useful life of 10 years and uses the straight line method of depreciation. On 1st January 2009, the asset's useful life is reversed to add a further 3 years to it. The asset has no residual value. The depreciation charge for the year to 31st December 2009 should be as follows.
Okay, so then I gave us, yeah. Okay, this is a good question, right? They want us to calculate depreciation for 2009. Abi? Okay, so let's look at it this way. Let's look at it this way. When did they acquire the asset? 4 January 2006. This is the date of acquisition. What's the cost of the asset? What's the useful life? What's the residual value? None. Okay. So, my depreciation per annum, what's the method of depreciation? Straight line. So, it's cost minus residual value divided by what? Minus estimate divided by estimated. And the cost in this case is how much? It's 10 million. Residual value is what? And useful life is how many years? That means my depreciation is how much? Per annum. Abi? So every year for the next 10 years ordinarily should be 1,000. So if that's the case, that means at the end of year 1, which is 31st December 2000 and what? 6. So when I'm talking about depreciation and you just see me write that year, know that it's the end of that year. Okay? So what's my carrying amount? Is my cost minus what? Abi? And what's my cost? What's my accumulated depreciation? What's my carrying amount? So this will have settled year 1. Abi? In year 2, which is 2000 and what will be my depreciation? I don't need to do any calculation again because I know it's 1,000 per annum for my year 1. And what's my carrying amount? How much? Carrying amount is cost minus what? minus accumulated depreciation. What's my cost? My cost is my cost. It doesn't change. Okay? That's what we mean by historical cost. So the cost of that asset year in, year out does not what? Change. It will remain cost. And what's my accumulated depreciation? Thank you very much. In year 2, the accumulated depreciation will be how much? Meaning depreciation in year 1 and depreciation in year 2. That's why we call it accumulated. So this is going to be, that means my carrying amount is how much? 8,000. Now in 2008, what's my depreciation? It won't change. And what's my carrying amount? It's still going to be the cost minus what? And what's my cost? What's now my accumulated depreciation? What's my carrying amount? Now, this is where I'm going. In 2009, something happened. What happened in 2009? They revised the useful life. Abi? What was the remaining useful life before? The remaining useful life is what? Now, what's now the additional they have added to it? So that means at the end of 2009, we are now, based on the question, saying that the asset now has how many years again? 10 years. Yes, we understand, because I've told you that useful life, it's only an estimate they can make. So along the years, things can change, so they can revise it. So you just need to know how to incorporate it. So how will it affect our depreciation? Now, my question is this. Do you think the depreciation should still remain 1,000? Should this still remain 10,000? It cannot remain 10,000 because the variables has changed now. The variable is not these 10 years that we used. Again, ordinarily, it has changed. Now it's now additional 10 years. So when there is a revised useful life like this, in this case, we are seeing a revised useful life, then the depreciation from that date will change. It's going to be the carrying amount divided by the what? It will be the carrying amount at that date minus the what? Sorry, divided by the revised useful life. So when there is a revision, so the depreciation cannot continue from how we have continued before it to change. Now, at this date, what is the carrying amount as at this date? Is 7,000 from the previous year. Abi, what's now the revised useful life? Is 10 years. Abi, and what's now the depreciation? So from 2009 going forward now, it's now be how much? 700 going forward every year. Now, in the exam, this kind of question should not take you, it took us almost 5 minutes to solve it. It should not take you 2-3 minutes because you will not have followed this approach in the exam. I just wanted to teach you expressively, being the first question. That's why I took you through this history. Because what the question actually asks us is to calculate the depreciation for which year? 2009. So you have to focus on 2009. You don't need to go and start from 2006. So let me give you the alternative solution. The alternative solution is this. Or you just come to 2009. Okay? You just say depreciation, since you know that there was a revision of useful life. Immediately, don't use this cost minus residual value. Okay? Use the carrying amount Divided by the what? Revised what? Divided by the revised useful life. And what's the carrying amount? The carrying amount is the cost minus the what? Accumulated depreciation. That's how you calculate carrying amount. They already gave us the cost to be how much? And how do you get the accumulated depreciation? So you just need to know, okay, what is the depreciation they have charged till when? Till 2009. So the depreciation per annum they have charged before is simply 10,000 minus 0 divided by what? Divided by 10 years. And this is how much? 1,000. So from 2006 up to 2008, this is how many years? This is 3 years. You can use this long journey and do 1,000 multiply by what? And this gives you 3,000. You can use this, or you simply come here and do the costs over the what? Useful life multiply by how many years to that date, which is how many years? 3 years. So the one that you think is sufficient for you, so this will simply give you 10,000 minus how much? And that gives us how much? So you just come and put our 7,000 here over what? Revised useful life is 10 years, which gives us how much? 700 naira per annum, or 700,000 per annum going forward. In the exam, this is what you have to do. Okay, but start with this first to understand the principle. Understand the principle that, okay, we are going to 2009, but each year, depreciation is calculated like this. Year 1, year 2, until this date where there was now a revision. When there's now a revision, we have to start from what happened from that date going forward. So from that date, our carrying amount, you need to get it. Then what is now the new useful life? So the way to do that is that, yes, we are starting from here, but you need to calculate the carrying amount, which is the cost minus accumulated depreciation. The accumulated depreciation is 10,000 divided by 10 years. This will give you per annum, multiply by the 3 years, which I've expressed here for you clearly. The 3 years I'm talking about here is 2006 to when? 2008. Then that gives us this. Then we can easily get our carrying amount to be how much? 7,000. And the revised useful life is that, okay, you have spent 3 years, remaining 7 years. And they said we should add additional what? 3 years, making it 10 years. Then that gives us our carrying amount. So this is the beginning. I'll stop here for today. And we'll continue next week.